In this video, I'll explain what REITs are and why I think they're a great investment. I'm starting right now. So, in general, most people would agree that investing in real estate is a good idea. But how exactly would the average person do it? Probably with buying and selling houses, right? Now, this is of course a great approach, but it takes quite a bit of down payment money to get started and a lot of time, effort, and knowledge to squeeze profits out of residential real estate. Whether you flip homes or rent them out, it's not easy nor cheap, nor is it profitable right away. Same thing goes for commercial properties, except now you need even more money to get started in that business. Instead of this, wouldn't it be great to invest in real estate in the same manner you invest in regular companies by simply acquiring shares of stock? In fact, you can do this, and this is the central premise behind real estate investment trusts or REITs, which allow you to invest in all sorts of real estate and infrastructure much like you would in stocks of companies. So what exactly is a REIT? It is nothing more than a company that buys, develops, owns, and in most cases also operates income-producing real estate. What sort of real estate? It can be retail space, industrial, self-storage, data centers, hotels, medical centers, residential, and many other types. Where exactly does the income stream come from? Quite simply, rent. So to summarize, a REIT is a company that does the following. 1. It collects money from investors by selling company shares. 2. It uses this money to buy and develop economically desirable real estate. 3. It produces income by charging rent on these properties from paying clients. And 4. It pays out a regular cash dividend to the investors for their investment. Now, the investors simply buy shares in whatever REITs they choose and hold them like any company stock, selling them if they want to, or otherwise hanging onto the shares and receiving cash dividends. Bottom line is that REITs present excellent opportunities to get in on real estate investing, especially commercial real estate investing, and to preserve liquidity by not actually having to purchase real estate directly. So where did this all come from? REITs as we know them today appeared in 1960 and from the beginning were designed to allow real estate investors the opportunity to diversify their portfolios with income-producing real estate holdings. The first REIT was American Realty Trust, a mortgage REIT, and it was established in 1961. Today, over 225 REITs actively trade on the US markets, and together they have a market capitalization of over 1.37 trillion while holding over 4 trillion in gross assets, and collectively owning over 580,000 properties across the US. An estimated 170 million Americans own shares in REITs either directly or through a pension or a 401k fund. So here are some essential facts about REITs that you should know as a potential investor. 3 main types of REITs exist today. Most of them are equity REITs, which own and manage land and properties. The second type is the mortgage REIT, which invests in mortgage-backed securities or bundled mortgages. Finally, the third type is a hybrid REIT, which combines both approaches. In this introductory video, I'll just talk about equity REITs as they are the most common type. As I mentioned, equity REITs can invest in almost any land or property, but their most common holdings are from a group of 12 categories. In alphabetical order, they are data centers, such as cloud computing, diversified, which is just a mix of properties, healthcare, such as hospitals and clinics, industrial, such as factories and commercial space, infrastructure, such as pipelines and cell towers, lodging resorts, which is mostly hotels, office, which is just corporate space, residential, which is apartment complexes and homes, retail, such as malls and storefront properties, self-storage, which of course is personal storage centers, specialty, which is miscellaneous non-categorized holdings, and finally timberlands, which is timber production. REITs can be public and traded on the exchanges, or public and not traded, and they could also be privately held. In this video, we will only talk about publicly held and traded REITs, and those are the most common ones. The entire REIT industry, by the way, is represented by the National Association of Real Estate Investment Trusts, or NAREIT, and you can find a lot of useful info about their member REITs on the website REIT.com. Finally, to finish up with the technical details of REITs, it's interesting to know that these organizations have a special tax status with the IRS, and certain provisions regulate REIT classification. A REIT must invest at least 75% of its assets in real estate or cash equivalents, and must also receive at least 75% of its gross income from rentals, property sales, or interest on mortgages. And finally, what is most relevant to investors, it must pay out a minimum of 90% of its taxable income as dividends to shareholders. So that was the technical and historic background on REITs. Let's now talk about the more interesting part, investing in them. What better way to start? By listing all the pros and cons. Pro number 1 is steady income. This is the main reason most investors flock to REITs. The steady and relatively high dividend payments, which are usually significant significantly more than most other dividend-paying stocks. Pro number 2 is portfolio diversification. REIT stocks are real estate holdings, setting them apart from regular corporate stock and government bonds. They do not necessarily follow stock bond trends or the economy in general. It's often said that when stocks zig, REITs zag, giving you a great opportunity to diversify and protect your portfolio. Pro number 3 is opportunity to invest in real estate. As I mentioned earlier in the video, to have actual real estate such as houses and buildings in your portfolio takes a lot of cash up front and a lot of management hassles once you buy. Owning REITs gives you access to real estate investing without the burden of purchasing and managing actual properties. Now, there are some cons as well. Con number 1 is dividend taxation. REIT dividends, in other words investor profits, with some exceptions, are taxed as ordinary income, not at the more advantageous capital gains rate which most other dividend profits are taxed at. Con number 2 is REIT sensitivity to interest rates. This topic can be somewhat controversial among financial experts. Common wisdom dictates rising interest rates are bad for REITs as share value decreases and investors divert their money to bonds. However, it's a complicated relationship because rising rates also indicate an economy heating up, which is good for the overall REIT business. And finally, con number 3 is little control over holdings. This may not matter much to income-seeking investors, but you have much less of a voice in what and where to invest with when you deal with REITs versus purchasing real estate yourself. You can certainly pick what sector you'd like your REIT to be in for some measure of control, but just don't expect to be able to tell the REIT specifically what holdings to acquire, just as you cannot tell a mutual fund what stocks to buy. Now, when you're considering what REIT to invest in, it of course helps to have some data to look at. With REITs, that data is a bit unique as compared to your typical dividend-paying company stock. Instead of looking at something like PE ratio or book value, you would instead need to analyze the FFO, which stands for Funds from Operations, which is a cash flow measure that is critical to evaluating the performance of a REIT. It is expressed as an FFO payout percentage, and the higher the value, the better. The second critical item to look at is the REIT's AFFO, which is the Adjusted Funds from Operations. AFFO is the extension of FFO and is intended to be somewhat more accurate representation. The metric is also known as cash available for distribution, and it adds in adjustments for recurring capital expenditures as well as gains such as rent increases. It is also expressed as a percentage, with a higher number being better. Finally, it should be mentioned that if you decide that analyzing individual REITs is not for you, you can always let someone else do this and invest in REIT exchange-traded funds or ETFs. There are about 24 such funds, and they vary by what type of REITs they have in their holdings. Just like stock mutual funds and ETFs, REIT ETFs may be a great idea for those investors who are too busy to pick up individual holdings but still want to get in on the market. Okay, so if you are willing to research and pick your own REIT investments, the very first thing you should do is think about what sectors to invest in, as clearly not all sectors are doing equally well. Think about what's going on right now as far as both long-term rentals and short-term ones. One observation we can state is that malls and corporate office space isn't doing as well as they used to in this post-pandemic world. In case of malls, this has been a long trend of decline, and with office space, it's more of a recent phenomenon because so many employees are still teleworking. So right there, you should probably avoid REITs that have extensive holdings in these two spaces. What is doing well? Well, for one, it's self-storage. Another growth area is data centers and infrastructure, as more than ever our life is online. So in this matter, go through all the assets that REITs typically hold and decide if these assets are on a decline or not, and invest accordingly. One final piece of good REIT advice is to look for REITs that lock in long-term leases with their clients, including what is called triple net leases, where the client pays for everything. When a REIT has these, it's a good sign of long-term profitability. Finally, to close out this REITs video, let's take a look at some of the better-known REITs so you have an idea of some of the names out there. Now, these are not endorsements in any way, rather an introduction to get you started in researching REITs on your own. Perhaps one of the best-known REITs out there is Realty Income, symbol O. Now, this REIT does deal with retail space, but the good kind, forming long-term leases with profitable consumer retail companies. Realty Income is also a dividend aristocrat and has increased its dividends for over 50 years. At the time of filming, its yield is 5.61%, and the shares currently trade at about $56 a piece. Digital Realty, and symbol DLR, is another well-known and very large REIT. They are one of the largest data center real estate operators in terms of number of properties owned, with just 300 facilities across 25 countries on 6 continents. Demand for data centers has increased significantly due to the pandemic, along with the demand for streaming services. The REIT's current yield is 2.84%, and the shares currently trade at about $172 a piece. The third and final REIT I'll introduce is STAG Industrial, symbol STAG, and this REIT invests in e-commerce warehouses, with Amazon being its largest client. STAG owns 493 such warehouses with a total of 92 million square feet. With the incredible growth of Amazon, this REIT has seen significant profits in recent years. Its current yield is 4.24%, and the shares currently trade at about $35 a piece. With all these REITs, you'll get a quarterly or sometimes a monthly payout when you own their shares. Okay, that was a fairly comprehensive overview of real estate investment trusts. As always, if you enjoyed this content, please do like and subscribe, and I'll see you in the next video.